All right. Today is Thursday, January 6th. This is a recap for the stock market activities today. Folks, I got a good one for you tonight. And let's start by this. The sell-off that we got yesterday is historic. Matter of fact, the heaviest tech selling in a decade was responsible for the sell-off that we got in the NASDAQ yesterday. So why is the index, the NASDAQ, and the triple Qs, for example, still trading close to all-time high? The answer is this. The majority of the pain came from profitless tech and expensive software, not the mega cap tech stocks that are responsible for the majority of the weighting in the NASDAQ and the SPY, the S&P 500. The take here is the fact that the correction that we got in the NASDAQ is due to multiple detraction, not expansion, as the 10-year yield climbs higher. Does that mean that the big caps are immune from the multiple detraction? Not really. Their turn to have their heads on the chopping block is coming. But in the beginning, they hit the profitless tech, the high momentum, high growth names, the expensive software kind of names, and then they're going to move to shoot the big caps. Now, looking at this chart, the interesting take is there is a high degree of correlation between expensive software, profitless tech, and the NASDAQ. They top together, they bottom together, but the latest move is different. There is a divergence here. Profitless tech and expensive software top before the NASDAQ. So are they a leading indicator that the NASDAQ is about to face the same fate? If that is the case, the NASDAQ will go down or perhaps lose at least 10% of its value. It all depends on the performance of the big caps. Now, here's another indicator that you have to keep in mind. The percentage of stocks down 50% from the 52-week high in the NASDAQ composite. We have never seen such elevated readings since the 2020 crash, the COVID crash, the financial crash in 2009, and then the implosion of the dot-com bubble back in 2000. Is this indicator telling that the NASDAQ has already topped? Of course not. If anything, this could tell us that the NASDAQ has another run to go before it tops. But we use this indicator to assess the risk versus reward. And looking at this chart, this indicator, the risk versus reward, is not favorable to the NASDAQ. So as an investor, you have to look at this indicator and say, where am I overweight in my portfolio? If it is all tech, then you gotta start diversifying because the risk versus reward is not favorable toward the NASDAQ. And if you're like me, you hold a long and short portfolio strategy, you gotta start looking for shorting opportunities. The hammering in technology stocks that began to spread into the broader market Wednesday is being fueled by one of the most intense bouts of selling by professional speculators since the financial crisis. Now, I want you to notice the contrast between institutionals and retail investors. We start with the institutionals. Hedge funds, which spent December unloading high growth, high valuation stocks, began the new year by jettisoning software and chip makers at a furious pace. During the 4 sessions through Tuesday, these sales reached the highest level in dollar terms in more than 10 years, data from Goldman Sachs shows. And we talked about this in this program a while ago. Hedge funds were already positioning with expectations that the 10-year yield will pop higher. We talked about the positioning from the Cayman Island entities. They started dumping bonds and betting that the 10-year yield will pop higher, and therefore their portfolio strategy followed accordingly by dumping high valuation stocks. Why is the 10-year yield popping higher, by the way? The answer is inflation. And is inflation cooling down? We had some indicators that inflation is indeed cooling down, and this is from the ISM Manufacturing Index. The problem is you have to factor in the impact of the Pokemon variant. Here's another indicator that solidifies this theory, that inflation is not transitory, but the dip in inflation is. Today we got data from new factory orders. And notice the dip, it started to cool down. And then if you look at the columns, you can see that factory new orders are actually accelerating higher again, meaning perhaps factory orders took a dip due to the variants, the D and now the Pokemon. Yet slowly but surely, these new orders are being revived and accelerated once again. What does that mean? Inflation will continue to rise higher until the Fed starts becoming more aggressive in their monetary policy. So this is what the institutions are looking at. Let's contrast that with the outlook from retail investors, the mom and pops. What are they doing? We know that they've been programmed on autopilot to buy the dip every single time, and they're doing the same thing yet again. The headline from the Wall Street Journal reads, "Meme stocks slump to start new year. Individual investors' favorite GameStop and AMC are off to a rocky start, with both losing more than 10% in 2022. Hold that thought because something happened after hours. But here it is. Individual investors have remained active in the market in 2022, buying a net $3.9 billion of U.S. stocks and exchange-traded funds, aka ETFs, in the first trading days of the year. Data from Vanda Research shows. What does that mean? We have at least a $3.9 billion worth of bags because they bought expecting the Santa rally to continue, and you and I know that Santa just delivered the bags. They have remained net buyers of GameStop and AMC too. Perhaps this one is rewarding, at least for tomorrow. Hold that thought. Individual investors have purchased almost $1.8 million of GameStop and nearly $15 million of AMC shares on net basis this year. Again, data from Vanda through Wednesday shows. So not a lot of buying here of meme stocks. We're talking about $17 million out of almost $4 billion. So where did the rest go? Here it is. That buying activity, however, has been eclipsed by their interest in other stocks, including chip maker Advanced Micro Devices, AMD, and Apple. So they got sucked in buying Apple, the $3 trillion, the headline that the criminals got us, and then they dumped right away on the top of the heads of mom and pops, retail investors, who bought the dip, and they thought that Apple is going to rally from this point on after the $3 trillion headline. Unfortunately for them, they're not watching the Maverick of Wall Street. I told you in this channel, they're going to get the $3 trillion headline, and that will be the top for Apple, at least for now. Because historically speaking, every time we get the trillion milestone, it marks a top in Apple. The $1 trillion did, the $2 trillion did, and now the $3 trillion headline. Now, meme stocks are not off on a good start for the year. Matter of fact, meme stocks have reached their lowest levels since the mania began almost a year ago. But after hours, we're seeing an interesting phenomenon. Yesterday, we talked about GameStop and how the short covering squeeze is not going to happen. It's not going to be the factor that pushes GameStop to trade at all-time highs or perhaps above that. It's not going to be the technicals. Certainly, it's not going to be the fundamentals. What's going to push AMC and GameStop for that matter higher is a new flow of money, new flow of buying, another episode of the mania. How do you ignite a new episode of the mania? These companies have to change strategies. They have to start to throw buzzwords, interesting endeavors, interesting updates to the strategy. This is exactly what we talked about yesterday. Today, the management of GameStop updated their strategy, and now they're shifting into the NFT crypto market. Okay, that's a good step. Whether this endeavor works or not, the bottom line is throwing the buzzword, while it still has an impact, will work in exciting new inflows into GameStop, and that what will push the stock higher. Now, if the management of GameStop is listening, where is the metaverse? I want to hear about the strategy of including GameStop in the metaverse. I want to hear the strategy of GameStop inducing the EV mania. I'm not saying GameStop would announce manufacturing a new EV. They might do that. Why not? Everybody's doing it. But in all seriousness, how will GameStop use such an exciting segment of investing, EVs? How will they adapt their platform to be included in the EV ecosystem? What will GameStop do to be part of the online gaming ecosystem? We're talking about Twitch, we're talking about Roblox, and perhaps the upcoming streaming service from Netflix, the gaming streaming service. How will GameStop play a role in all of these developments? If the management answers all of these questions and build on the momentum that we got after hours today, you could see the stock popping higher aggressively because we will see new inflow of money. Clearly, from the data I just shared with you, the retail crowd, the mom and pops, still have plenty of money to pour. They just poured $3.9 billion in buying the dip. They have plenty more here. They can buy a lot of GameStop, a lot of AMC. And by the way, what about AMC? Where is the streaming service, Mr. Adam Aaron? You have an interesting catalog of content under AMC's umbrella. Why not use that to launch a streaming service? That will pop the stock right away 20-30% higher. But anyhow, this is the update of what's going on regarding the market dynamics right now. But let's move on to In Focus tonight. The main topic is the crooked criminal insider trading activities at the Federal Reserve. And this time around, we're going to concentrate on vice Chairman Clarida. Today we got a report, a disturbing report, showing that Clarida lied in the filing. His trades were already concerning, but this latest update make them even more concerning. That this wasn't just a mere coincidence here. It was timely planned. It couldn't be a coincidence. This man used insider information to make personal profits. This is a crime, and he is getting away with it, and therefore, I'm making this topic the highlight of this video. And I hope that you're gonna like this video, and you're gonna share it with others, because more people need to hear this story. The majority of the American public is not even aware of the crimes of the Federal Reserve, be it inflation, be it the massive wealth inequality, be it destroying the American dream of owning a home, be it manipulating the stock market and the commodities market. And on top of that, oh, by the way, Fed officials got caught insider trading, and they got away with it. The American public deserve to hear this story. But let's start with this. St. Louis Fed President James Bullard, who is well known to be blunt, shall we say? Did I say blunt? And he has been, if you can call it, hawkish from the get-go. That doesn't mean that he was not supportive of the greatest transfer of wealth in history, courtesy of the Federal Reserve. But he was outspoken from the beginning that the Fed's policy could lead to higher inflation, and he argued that the Fed had to unwind the assets purchasing programs and the easy money policies way before the rest. Today, Mr. Bullard reiterated the fact that the Fed could be even more hawkish. We got the FOMC minutes. We know Jerome Powell is now hawkish. On top of that, even the King of Doves, Williams, started talking hawkish. And the demon from Minneapolis, Neil Kashkari, who said we will never raise interest rates, defended the policy over and over and over again, and continued to say that inflation is transitory. Even Neil Kashkari is now calling for higher interest rates. And now we have Bullard saying that higher interest rates could happen as soon as March. And oh, by the way, we will start unwinding the balance sheet hand in hand with raising interest rates. Ultra hawkish. What's going on here in the Fed? Why are they all of a sudden becoming hawkish? Why are they all of a sudden agreeing that interest rates should move higher? It couldn't be inflation. Inflation has been going on for a while now, surging higher out of whack. The data was clear that inflation is way above the Fed's target. So it couldn't be inflation that persuaded Fed members to become hawks and support raising interest rates. So what caused them to change their minds? Before we answer this question, here's another Fed zombie from San Francisco, Mary Daly. Today she came out and said, inflation has been higher than I'm comfortable with for a long time. Daly added, we will need to raise interest rates to keep the economy in balance. Oh, you think? And here's just a reminder for you of what Mary Daly said back in November when we got one of the hottest CPI readings in history and real interest rates were already negative, matter of fact, surpassing the negative readings from the 1970s. Take a look.
We do have to talk about inflation. And it's not often you can celebrate economic history. But today is one of those days because given this morning's CPI, we are now looking at a real yield of roughly negative 6%, which is lower than we got in the 1970s. Does that tell you that we have a problem?
Well, certainly we have a challenge right now. Inflation is higher. It's eye-popping, right? It catches people's attention and it hurts their pocketbooks. The issue, though, is that we still have COVID. And COVID's still an issue globally, and that's affecting supply chains. It's affecting the ability to go out and buy services. It's affecting the ability to meet in person. This is my first in-person meeting. And that matters for inflation. It matters for jobs. And so this is a transitory period. That's what we believe. That's what I think when I look out at the data. But it's directly related to COVID. And as quicker we get through COVID, the better off we're going to be as an economy.
So Mary Daly said, inflation is transitory. Don't worry about it. We cannot raise interest rates or become too hawkish because we have COVID. And this was back in November, folks, not a long time ago. Now we have cases at all-time highs. And all of a sudden, Mary Daly changed her stance where COVID is no longer a concern. And oh, by the way, it's not transitory. And she's calling for higher interest rates. What happened here? You think this is a coincidence or this is just a reassessment of the data? Of course not. These are orders that come from above. Who's above? I want to keep my channel, so I'm not going to tell you that, but you will find out that this satanic cult have already decided that the way forward is higher interest rates, regardless of the ramifications and the implications that will have on the economy and the broader stock market. You combine that with the fact that we're seeing the highest insider level activities of selling that we've seen in a long time. You put two to two together. This is part of the so-called agenda. So don't be surprised to hear from the ECB, the Bank of England, and the rest of the central bank cabal that they're also getting hawkish and raising interest rates higher. So a lot of you out there who accuse me of being too bearish, oh, the Fed is never going to raise interest rates, relax, they're just bluffing, yada, yada, yada. You better wake up. They're not bluffing. It is all part of an agenda. The agenda was reinflate everything and now deflate everything. The difference is the inflation was good for the rich. The deflation is still good for the rich, but it's not good for you and I, regular folks, because it will come in the form of assets devaluation, meaning stocks down, real estate down, loss of jobs. So these rich can scoop them all at a cheaper price. But this is who I want to talk about tonight. Richard Clarida, the vice chair of the Federal Reserve. Now, you and I know this is not news to us because we covered this multiple times in this channel. The Fed has been caught insider trading. Using their advantage, the Federal Reserve is the biggest market maker in the world. They can move assets up and down by a statement. A simple statement can pop the stock market higher or crash it down. While they enjoy this great control over the market and assets across the board, they use this advantage to enrich themselves. Isn't this a crime or not? And all of them, by the way, from the top to the bottom, including Jerome Powell, Richard Clarida, Bob Kaplan, Eric Rosengren, they all got caught insider trading. And Jerome Powell came out and said, what? What insider trading? We did not disobey the rules. You know, the rules that we made for ourselves. The rules that are so loose that allowed us to do this insider trading to begin with. We did not violate any of these rules. But I know the American public is concerned about the image. Their trust in the Fed is down. And therefore, what is the punishment? They get to retire. They take the money and they retire and perhaps join the private sector. And this is what happens, folks, when you hire incompetent people, corrupt people from Goldman Sachs and PIMCO to lead the Federal Reserve. Now, the scandal revolving around Clarida is the fact that he bought the stock market, he bought an ETF, a fund that represents the stock market, a basket of stocks, right before his boss, Jerome Powell, came out and unleashed the tsunami of liquidity, which you and I know was responsible for rescuing the stock market and the insane bull market bubble that followed thereafter. So to begin with, it doesn't look good. The timing doesn't look good. You bought right before your boss, and by the way, you're the vice chair. You have advanced knowledge of what's going to happen here. You know the stock market is going to pop higher, so you buy ahead of time. This is bad to begin with, but today we got a new revelation that makes this trade even worse than we originally thought. And this is according to a report from the New York Times. The headline reads, "Remember the Fed trading scandal? Vice Chair Rich Clarida corrected his disclosure, and his controversial trade now looks even more eyebrow-raising." What are they talking about here? Here's another tease for you. A Fed official's 2020 trade drew outcry. It went further than first disclosed. Corrected disclosures show that Vice Chair Richard Clarida sold the stock fund, then swiftly repurchased it before a big Fed announcement. What a great market timing here. And this makes the trade way worse than we originally thought. This article was written by Gianna Smilik, who we talked about before in this program, but I want to read this report from Politico's, I forgot her name, Guida, whatever her name is. She's always in the Fed conferences asking questions. I love how she described Clarida's actions. Federal Reserve Vice Chair Richard Clarida quietly admitted, I love this, quietly admitted, that makes it a little better, right? I quietly admit that I committed crimes. I quietly admit that I cheated on my wife. If I quietly admit, makes it a little better, right? I'm not loudly admitting, I'm not tweeting about it. Clarida quietly admitted last month that he had failed to fully disclose financial trades he made at the end or at the onset of the pandemic, the latest revelation in a string of ethics problems at the central bank. Let's go back to the original author of this report. Richard Clarida, departing vice chair of the Federal Reserve, failed to initially disclose the extent of a financial transaction he made in early 2020 as the Fed was preparing to swoop in and rescue markets amid the unfolding pandemic. Mr. Clarida previously came under fire for buying shares on February 27th in an investment fund that he holds stocks one day before the Fed Chair Jerome Powell announced that the central bank stood ready to help the economy as the pandemic set in. The transaction drew an outcry from lawmakers and watchdog groups because it put Mr. Clarida in a position to benefit as the Fed restored market confidence. Mr. Clarida's recently amended financial disclosure showed that the vice chair sold the same stock fund on February 24th, at a moment where financial markets were plunging amid fears of the virus. So you might say, who cares? It's just 2 days here. He sold on the 24th and then he bought it again on the 27th. What's the big deal? The big deal is this is insane market timing. To avoid losses and maximize your profits, this couldn't be done without insider information. The Fed initially described the February 27th transaction as a previously planned move by Mr. Clarida away from bonds into stocks. Oh, really? The type of quote-unquote rebalancing investors often do when they want to take on more risk and earn higher return over time. But the rapid move out of stocks and then back in makes it look less like a planned long-term financial maneuver and more like a response to market conditions. She's being generous here. She should have said insider trading information. It undermines the claim that this was a portfolio rebalancing, quote-unquote, said Peter Conti Brown, a Fed historian at the University of Pennsylvania. This is deeply problematic, quote-unquote. The Fed did not provide further explanation of Mr. Clarida's trade. When asked why he had sold and bought in quick succession, asked if the Fed stood by previous indications that the move was a rebalancing, a spokesperson did not comment. The correction to the disclosures was released late last month and came after Mr. Clarida noticed inadvertent errors, quote-unquote. That's nice, isn't it? It was just an error. I didn't notice that. I didn't have my glasses on. I noticed how they excused all of this, that it's not a crime because he did not buy individual stocks. He just bought an ETF. He bought a fund. It couldn't be insider trading. Bullshit. Doesn't matter to me if you're buying an individual stock or an ETF or a fund. That doesn't matter. The timing is telling. A Fed spokesperson said, noting that the holdings were in a broad fund or broad funds as opposed to investing in individual stocks. Mr. Clarida did not comment for this article. Who cares if it is individual stocks or broad funds? Again, the timing is what we're concerned about. The extent of Mr. Clarida's transaction is the latest development in a month-long trading scandal that has embroiled top Fed officials and prompted high-profile departures at the usually staid central bank. Financial disclosures released in late 2021 showed that Robert S. Kaplan, the former Federal Reserve Bank of Dallas, had made big individual stock trades, while Eric Rosengren, the Boston Fed president, had traded in real estate securities. Those moves drew immediate and intense backlash from lawmakers, ethics experts, and former Fed employees alike. I'd like to see more outrage from the public, because these criminals, these white-collar criminals, should not walk away punishment-free. Once they got caught insider trading, all of a sudden they started retiring. Oh, I got a kidney failure, I got cancer, like mob bosses. Once the trial begins, all of a sudden they're all sick. Mr. Kaplan resigned in September, citing the scandal. Mr. Rosengren resigned simultaneously, citing health issues. Mr. Clarida's term ends at the close of this month, which it was scheduled to do before news of the scandal broke. Mr. Clarida's trades, which Bloomberg reported earlier, also raised eyebrows among lawmakers, including Senator Elizabeth Warren of Massachusetts, who has demanded the Securities and Exchange Commission investigation into Fed officials' 2020 trading. This is not going to happen, of course, because the head of the SEC, Gary Gensler, remains in a coma. But many ethics experts had seen the transaction as more benign, if poorly timed, really, because it happened in a broad-based index, and the Fed had said it was part of a planned and longer-term investment strategy. Oh, the Fed said they did not commit crimes. The criminal said he did not commit crimes. The bank robber says he did not rob a bank. He was just pulling a prank, and the bank teller fell for it. The new disclosure casts doubt on that explanation, given that Mr. Clarida sold out of stocks just days before moving back into them. It is peculiar, quote-unquote, said Norman Eisen, an ethics official in the Obama White House, who said he probably would not have approved such a trade. He also added, "It is fair to ask, in what respect does this constitute a rebalancing? Mrs. Warren reacted to the news on Twitter, calling the situation, quote-unquote, deeply troubling and saying that stock trading should be banned among federal officials. Here's the tweet from Senator Warren. This behavior is why I called for an SEC investigation of the Federal Reserve officials for this insider trading. It is deeply troubling and further evidence of potentially illegal activity. How about crime? That would be more appropriate. We need to ban stock trading by federal officials. Tell that to Nancy Pelosi, by the way. Back to the article. It is unclear whether Mr. Clarida benefited financially from the trade. Oh, you think he did not benefit? He must have lost money, right? But it was most likely a lucrative move by selling the stock fund as its value began to plummet and buying it back days later when the price per share was lower. Mr. Clarida would have ended up holding more shares, assuming he reinvested all of the money that he had withdrawn. The financial disclosures put both transactions in a range of $1 to $5 million. But it's unclear whether Mr. Clarida benefited financially from the trade. Wow. But the fund's value recovered after the Fed's extensive interventions in markets. Assuming they were held, the holdings would ultimately have appreciated in value and turned a bigger profit than they would have had Mr. Clarida merely held the original investment without selling or buying. Mr. Powell will appear before the Senate Banking Committee next week for his confirmation hearing, as well as Lael Braindead, a Fed governor whom Mr. Biden nominated to replace Mr. Clarida as vice chair. Both could face sticky questions about why a Fed culture permissive of trading at activist moments was, until recently, allowed to prevail. Mr. Powell led the organization while Mrs. Braindead headed the committee in charge of Reserve Bank oversight. Just an illustration for you here, and this is not what Clarida did, but this is an example. This is a chart of the SPY, the S&P 500. Let's say you were holding the SPY until the crash started in February 2020, and as it started to appear that the SPY is breaking down, you sold your holdings. You're done. And then you buy exactly at the bottom, a day before Fed Chairman Powell came out and announced the rescue plan. Isn't this suspicious? I say it is suspicious as I can explain the selling. Yes, the ETF, the index, whatever he was holding, broke down. I would have sold too. And these are all, by the way, former Goldman Sachs and PIMCO employees. They know how to trade the market. But the buying a day before Powell came out with the rescue plan is the problem. Now, we originally thought that Clarida just bought the ETF a day ahead of Powell's announcement. But what we didn't know back then, when the disclosures happened, is the fact that he was holding the same fund, dumped it as it was going down, and then rebought it again just a day before the rescue plan was out. You cannot explain this. You can weasel your way around, but this is insider trading. This is the definition of insider trading. And no, he did not buy $10,000 or $25,000, because if that was the case, we would have said, okay, he made $5,000, who cares, right? But we're talking about $1 to $5 million. The entire toxic culture in the Fed has to be reformed, and he cannot reform this toxic culture with Jerome Powell at the top. And folks, I want to conclude with this. We have rampant corruption all over the government, not just the Fed, but within Congress, the Senate, and God knows, in localities and states. It's all over the place. It's a culture of rampant corruption. It used to be the public service was motivated by serving your community, serving your country, not to make money from the service. And I'll leave you with legendary Fed Chairman Paul Volcker, one of a kind. When Ray Dalio asked him, "What do you want your legacy to be?" Listen to his answer.
Paul, what would you like your legacy to be?
Oh, God, my legacy. I'd like to see my legacy a more effective government in general. I haven't got any control over the high politics or any influence, but I would like to see a general acceptance of the need for an efficient public service ethic and see people attracted toward public service because they can take satisfaction that they're doing something concrete for the country and the people generally, and it can certainly test their own acumen and intelligence and energy to do that kind of thing. You know, my father, I'm sure, got restive about spending so much time in government, but I'm sure that in the end, he found that a satisfying career and didn't make a lot of money. He made enough to live on, simply enough. I would like to see that kind of spirit permeate a wider population. And it once did, there's no doubt about it. When I grew up, when I got out of college, when I got out of graduate school, going into government was a popular thing to do. Now people scratch their head and say, why would you ever want to do that? And that's not a very healthy sign, which goes along with the 20% confidence in government to do things right. Back when Kennedy came in, it was overdone. With all the spirit that he had, and I was a young man and full of Kennedy glamour or respect for it. You asked that same question, do you trust your government? It got up 60 or 70% said yes, so that's a healthy, we should be skeptical. I want 30% to be skeptical. I want more than 30% to be skeptical. Being skeptical is one thing, but being anti-government is another thing. We pair it, we don't dismiss it.
Anyhow, let's move on to cover the market's information for you, starting with the performance. And here we go. The Dow Industrial Average is down by 170.64 points, or a decline of 0.47%. The Nasdaq also closing in the red, down by 19.31 points, or a decline of 0.13%. The S&P 500 also down by 4.53 points, or a decline of 0.10%. What about the sector's performance today? Leading the pack at number 1, capturing the gold medal, energy. At number 2 for the silver, financials. Number 3 for the bronze, communication services. The laggards of the day led by utilities, healthcare, and materials. The theme appears to be inflationary. We have energy and financials leading, but what's up with materials? They're not enjoying a rally today, and you could say, oh, it's gold. Gold went down. No, even copper went down. Freeport-McMoran was down too. So this is the peculiar element of the rally today in the inflationary sector of the market, the absence of materials. Moving on to the advance to decline ratios, NYSE 54% advancing versus 44% declining. The Nasdaq 46% advancing versus 49% declining. Nothing to see here. The issues pretty much in the flat line, an equal distribution, but underneath it all, the breadth is still bad for the Nasdaq. Look at the 52-week highs versus the 52-week lows. 65 52-week highs versus 391 52-week lows. Unbelievable here. Moving on to futures, commodities, what's going on? The rally in energy continues to go on, but all in all, a pullback in commodities along with the stock market. If the Fed is going to be aggressive, then even commodities are going to start to take some air out of that bubble. In the meantime, money has to chase something here, and it is chasing value stocks in the stock market. But here in the commodities market, the money is still chasing energy, specifically crude oil. The WTI gained over 2% today. Matter of fact, 2.25% today. Brent, comfortably above 80 now, closed the day with gains of over 1.5%. Likewise, we have gains for gasoline and heating oil, while natural gas closing slightly in the downside. The performance of commodities, all in all, is becoming more correlated with the performance of the 10-year yield. The peak of the correlation happened last summer, but now look at this, we're rising again. As the 10-year yield moves higher, so are commodities. So if this relationship continues, and if you want to bet on higher yields, one way to play it is buying commodities. And here's some energy news for you, specifically for natural gas. We talked about the arbitrage between European prices versus natural gas prices in Asia. The arbitrage opportunity diverted a lot of ships from Asian destinations to European ones, and therefore European natural gas prices are taking a hit because the supply is all rushing to European destinations take advantage of the arbitrage while it's still here. What is that going to do to Asian natural gas prices? The answer is it's going to push it higher, and this is exactly what we're seeing. Asian natural gas prices, I don't know if you can see it or not, but they went down, and then as all of these ships diverted back to Europe, gas prices in Asia, North Asia in this case, popped higher. So at some point, this arbitrage opportunity will cool, and we will see more ships full of liquid natural gas heading back to Asia. We are also monitoring what's going on in Kazakhstan due to the implications on uranium prices. Kazakhstan happens to be one of the top uranium producers, and therefore the unrest that we're seeing right now in that country might impact uranium prices. For now, the top supplier, Kazatomprom, well, they're saying that the unrest did not impact uranium production yet. You saw some traders jumping the gun by buying calls or buying uranium futures. Now, when this news came out that the unrest did not impact production of uranium in that country. Today, we saw uranium prices diving down. But I do expect volatility here in uranium prices because you're going to see more betting that perhaps the unrest will get larger and it will impact the production of uranium from Kazakhstan. On the other hand, you're going to see another batch of traders shorting uranium, betting that all of those upside bets, assuming that uranium prices will move higher, will fire back because the unrest will be contained now as Russian troops move in to contain the unrest in Kazakhstan. Back to the futures, what about softs? The rally in lumber remains relentless here. Home builders have no other choice but to continue to buy. You cannot bargain here. You cannot wait for better prices. You have to buy with the assumption that inflation is not transitory, and this is pushing lumber prices higher, which will impact housing prices higher. On the other hand, we have flattish activities for coffee, yet a down day for cotton, OJ, cocoa, and sugar futures. What about metals? What a beating. Gold down, silver down, platinum down, copper down, palladium down. They all took it on the chin today, even though we did not see any major move in the US dollar or the 10-year yield. My hunch here is we have a big whale, a large holder of a materials ETF, and they decided to dump for whatever reason, and that impacted all materials prices down. What about meats? What's going on here? Modest gains for both lean hogs and feeder cattle futures. On the other hand, live cattle pretty much on the flat line. What about grains? Negative picture across the board. The losses were led by oats, wheat, soybean oil, soybeans, and soybean meal futures. On the other hand, we have canola and rough rice pretty much on the flat line, while corn closing with modest gains. Moving on to the big casino, the options market. What's going on here? Leading the pack at number 1, the hottest table by far, AT&T, with a little over 2 million contracts traded today. About 96% of those were calls. By now, you know that this is a dividend play. They sell upside calls right before dividend day because we have holders who are holding AT&T for the sole purpose of catching a dividend. Once they get the dividend, they dump right away. And therefore, if you're a long-term holder of AT&T, you take advantage of that by selling upside calls. Now, as a trader, I will take advantage of this. I already did, by the way, by buying puts. Look at AT&T's chart. A nice rally as of late, almost 21.5% gains, bottom to top, but it pulled back. And it is overbought, way overbought on the daily chart from an RSI and MACD indicator perspective. And therefore, the risk versus reward says buy puts, bet on a pullback, perhaps all the way down to 25 or 24, and you close it right away. These are wild shots. We did one just a few days ago with Cisco, and that paid out handsomely. Let's see if this one is going to work or not. But here it is at number 2. Apple, with almost 1.4 million contracts traded today, about 66% of those were calls. And at number 3, Tesla, the souffle, with almost 850,000 contracts traded today, about 54% of those were calls. Moving on to the unusual activities that took place in the options market today, starting with the ticker TRQ. This is for Turquoise Hill Management or Resources, whatever it is. They're buying puts here. The name's beaten down, by the way, and they're betting for more pain to come by buying the $14 puts for the expiration date, February 18th, with the expectations that the name could drop down by more than 9% by then. They paid about 70 cents apiece to enter this trade, all in all, spending about $2.5 million. What about the trade for the ticker ARKF, or Tesla Witch Cathie Wood? This is her fintech ETF, and boy, the shorts are piling in here. They placed Cathie in their heads, and they're hammering down. And this is just a warning for the bulls, by the way. All the mania and insanity that you saw on the upside, you will see that on the downside multiplied by 10. Because once the bears pile in, they're going to be vicious. Look at what's going on in Moderna, for example. And this is happening in Cathie Wood ETFs. In this case, they're buying the 33 puts for the expiration date, February 18th, with expectations that the name could drop down by more than 10% by then. They paid all about $1 a piece to enter this trade, all in all spending about $3 million. What about the trade for the ticker RIVN, Revion? It's an intelligent trade here. I wish I followed it. It's a spread and actually a calendar spread. They bought the $70 puts for the expiration date January 14th, meaning next week, and they sold the $80 puts for the expiration date tomorrow, January 7th. all in all reducing the entry cost to about 20 cents apiece, and all in all spending about $250,000. Now, this trade could go wrong if Revyon crashes tomorrow and it trades below 80. The likelihood is it will not, and that 80 leg will expire worthless, and therefore, when we get to next week and perhaps Revyon trades closer to 80, maybe below that, it doesn't have to go all the way to 70 for this trade to be profitable, because the entry cost is only 20 cents. If this appreciates to 50 cents or a buck, it could do that rapidly. A really intelligent trade here. What about the ticker AFRM for a firm? Once again, my bet is we have an insider who continues to ride calls. But on the other hand, we have somebody buying the 95 calls for the expiration date February 18th with the expectations that the name could pop higher by more than 17% by then. And they paid about $6 a piece to enter this trade, all in all spending about $6 million. What about the trade for the ticker BYND, Beyond Meat? We had a gap and crap yesterday. The optimism about the new KFC fried chicken sandwich or product, whatever it is, not gonna try it, even if you pay me. But that pop faded right away. Yet Beyond Meat rebounded today. We have somebody bidding for more gains to come by buying the $80 calls for the expiration date March 18th, with the expectations that the name could pop higher by more than 19% by then. They paid about $4 a piece to enter this trade, all in all, spending about $4 million. What about the trade for the ticker SEC Limited? This is a company from Singapore, and we had some bad news that Tencent is dumping C Limited. That impacted the name for a little while, but we continue to see upside bits for C Limited. In this case, they're buying the 225 calls for the expiration date, January 28th, with the expectations that the name could pop higher by more than 17% by then. They paid about $2.30 a piece to enter this trade, all in all spending about $1.7 million. What about the trades for the ticker LCID Lucid Motor? Now, I believe it is the same trader who opened the Revyon trade, also opened Lucid. In this case, they bought the 35 puts for the expiration date, January 14th, and they sold the 33 puts for the expiration date tomorrow, which happens to be January 7th. The expectations here that Lucid will drop down, but it will not close tomorrow below 33, and that leg would expire worthless, and then the trader will close this trade at a profit next week, assuming that Lucid Motors trades below 35 or closer to 35. By using this strategy, they have reduced the entry cost to about 85 cents a piece, and all in all spent about $600,000 on this trade. The beauty of this trade is, next week, they could sell the 33 puts with the expiration date January 14th and raise more cash and lower the entry cost even more. Let's say they manage to reduce the cost to 40 cents a piece, with a maximum profit target of about $2. This is a decent trade. The risk versus reward is worth it. And lastly, at the bottom of the table, what about the ticker GLD? This is the gold ETF. They're buying calls here. We have somebody positive in gold, even though it was a brutal day today. They're buying the 178 calls for the expiration date March 31st, with the expectations that the GLD will pop higher by more than 6.5% by then. They paid about $1.30 a piece to enter this trade, all in all spending about $780,000. Moving on to the heat map analysis. What's going on here? The theme continues. Value outperforming growth, and the inflationary stocks outperforming all of them, and therefore financials popping higher, energy outperforming. The mystery is the lackluster performance of industrials and then the negative performance of materials. On the other hand, we're seeing some short covering, some bottom fishing on the high momentum, high growth, high valuations kind of names, the likes of Nvidia, the likes of CrowdStrike, the likes of DoorDash, Twilio, even the Chinese names caught a bid today. But we're seeing a lot of pain across the market. The big caps mixed. Netflix took it really hard today. And look at gold, a massive beating, brutality. But that pairs in comparison with the brutality in health insurance stocks, specifically Humana. Humana was down almost 20% today alone because the profit target or the revenue target for one of their programs was underwhelming, and therefore that impacted all health insurance stocks down. Specifically, United Health, UNH, was down big, and that was one of the biggest drags on the Dow today. We also have a major down day for RCL, Royal Caribbean. Bucking the trend of other cruises, it wasn't a good performance to begin with, but we have exacerbated losses here for RCL, and the reason is we have short seller Hindenburg. Hindenburg announced that they're shorting RCL. They attribute the thesis to a combination of meme and reopening frenzy in Royal Caribbean. On the other hand, the fundamentals are not supporting what's going on with RCL at all. We'll see how this short is going to play, but the folks over at Hindenburg already proven that they have a great track record in shorting stocks and turning these shorts into profitable trades. We also have the ticker STZ for Constellation Brands. It went down over 3% today, even though they released what I thought would be good news for the company. Bad news to us, the consumer. Constellation Brands, the maker of Corona and Modelo, said it expects to hike beer prices this year due to rising costs and a shortage of brown glass. Let me break it for you. Even after the shortage in brown glass is over, these prices are not going to go down. But here it is, the heat map for the ETFs. Look at the outperformance of energy. Matter of fact, energy stocks already recouped all of the losses from the pandemic. A new milestone for energy stocks. We're seeing all ETFs this time around, XLE, XOP, all outperforming. Likewise, we're seeing financials, the the KRE for regional banks that tracks the 10-year yield is moving higher. But the rest of the activities here muted with the exception of the SOXL chips, and the reason is NVIDIA popped higher today. NVIDIA is moving higher due to options buying, but then it goes down when we see panic across the market and selling of the ETFs. The notable underperformance came from the GDX and the SLV, gold, silver, what a beating today. Moving on to charts, starting with the SPY 30 minutes chart. What's going on here? The chart opened down in the morning, but it caught support at around 466.5, a little below that, and it attempted throughout the day to reclimb 470 and recatch that as support. It failed multiple times across the day. Is it definitive rejection yet? No, it's not, but it is bearish because we're seeing a weak rebound here, indicating that perhaps the selling is not over yet. The gap at 467.69 is already closed, and now we're still looking for 466.5 as support. If that fails, if the selling continues, then we're going to look down at 461 for support. If we have a rebound higher tomorrow based on the news of the fake jobs number, then we will look at 470 as resistance. In all likelihood, it will come at a gap higher. We might risk the gap and crap phenomenon. The jobs number will impact the chart, no doubt about it. Will it be up? Will it be down? Well, that depends on the number. If we get a cold number, then we will entertain the thought that perhaps Jerome Powell and the pack will become less hawkish, and this will excite the market higher. However, if the jobs report is too hot, the number is too hot, let's say 1 million jobs created in December, then the market will panic because this will encourage the Fed to become even more hawkish and exercise more tightening. And therefore, good economic news is bad news for the stock market and vice versa. Here's the daily chart for the continuous contract for the S&P 500. What's going on here? We are retagging 4,657 for support, yet it is inconclusive. We have a doji candle. On top of that, we're seeing a negative divergence on both the RSI, MACD indicators. The selling is coming on accelerated volume. Once again, all of these are good signs for the bears. But your leading indicator should be the 10-year yield. If the 10-year yield tops and starts to pull back, then we will see the SPY, but specifically the Qs, the NASDAQ, moving higher. Speaking of the NASDAQ, here's a 30 minutes chart for the Qs. What's going on here? We had a pullback, caught support, not at 379 exactly, but a little above that, at the same zone where the NASDAQ rebounded from before in December. One way you can look at the chart is, and this is the bullish perspective, the short-term perspective, that this is a formation of a bull flag, and we will see another pop higher tomorrow, building on the rebound today. The bearish perspective says, in the long run, this is a bear flag formation. You could pop higher, but you're going to crap again because the predominant theme is bearish. Now, let's try to settle this dispute between the bulls and bears by visiting the daily chart of the continuous contract of the Qs, the NASDAQ. Does it offer anything different? The answer is not really. We have a doji candle indicating an indecision. We went down, we went up, we closed pretty much on the flat line. The momentum indicators remain negative. The selling is happening on higher volume. All of these are good signs for the bears. But the indecision is here for a reason. We have an important piece of data coming out tomorrow. If it comes out encouraging the bears to pile in even more, we will see a flush down candle. On the other hand, if we get a cold number, the cooks over at the Bureau of Labor Statistics decide to serve us a cold meal, then we might see insane short covering and a pop higher. That pop candle could take us all the way back to trade above 15,975. If the other scenario happens and we see another flush down, the support of 15,500 will be violated, and therefore we're awaiting a big move, one way or the other. It will all depend on the jobs number. And here's a 30 minutes chart for the IWM. What's going on here? It caught support a little below 218. It did not close the gap at 213. The positive news is for the bulls, the 218 was recaptured as support once again. The problem is it is not decisive. You can argue that the chart of the IWM, if you zoom in via 5 or 3 minutes chart, made a double top, and it's going to flush down tomorrow. It's going to violate the 218 support. The wild card is, look at the pop in GameStop and AMC after hours. Some of these meme stocks are big components of the IWM and small caps. If they pop higher, they could impact the IWM to move higher. So we have to wait and see how the wild card will impact the market. Recently, every time we see a pop in GameStop or AMC, the holders of these particular stocks treat them as an opportunity to get out and unload shares. And if that continues, the sell the rip mentality, then the pops will fade, and this will impact the IWM negatively. What about the Dixie? What's going on here in the dollar? No move, consolidating, not violating the support of 96. We have negative divergence on both the RSI and MACD indicators, but working those negative divergences via consolidation is bullish for the chart. And here's another piece supporting higher value for the dollar, because we're seeing inverse correlation between the 2-year yield, which is a proxy for the Fed raising rates, and emerging markets currencies. Meaning, when we see a pop in the 2-year yield, when market participants anticipate that the Fed will be more hawkish and will raise interest rates perhaps sooner, faster, and more than expectations, the 2-year yield pops higher. When that happens, we see emerging market currencies pulling down. When these currencies pull down, we see the dollar index appreciate higher. And when the dollar index moves higher based on the weakness of other currencies, we see a pullback in gold because gold does not appreciate weaker currencies versus the dollar. And therefore, we saw a massive flush down here in gold, erasing multi-days worth of gains. The good news is it is still trading above 1,763. I would love to see a retest of that number and take it from there. Now, the momentum indicators, the MACD and the RSI, turning negative in the chart of gold, suggesting that perhaps gold will indeed go back to retest 1,763 for support. And here's a daily chart of the 10-year yield. We're waiting and waiting and waiting for a pullback here. It is getting overbought. Look at the RSI, look at the MACD. The next resistance we're looking for is 1.77%. No doubt about it. The jobs number tomorrow will impact this chart one way or the other. A hot number, in my opinion, will pop this chart higher in anticipation that the Fed will jump the gun and become even more hawkish. If the number comes out cold, then we will see the 10-year yield cooling down as expectations of the Fed tightening gets pushed down the road. This is the assumption. It doesn't mean that this will happen exactly the way I'm describing it to you. Because traditionally speaking, before the Fed's manipulation of markets, when we get a hot jobs report, the 10-year yield pops higher in anticipation of a hotter economy, more growth, more good news. Not the case anymore. The markets are so distorted and so manipulated. And here's a weekly chart for the TLT. We're now trading comfortably below 149. No update here from yesterday. We have negative divergences on both the RSI and the MACD, selling on higher than average volume. Matter of fact, the third largest exodus from the TLT, and this will not continue until we get a piece of data that suggests otherwise. This could be tomorrow's jobs number. It could be next week's CPI number. And here is a 4-hour chart for the VIX. What's going on here? The chart is flirting with 20. It wants to recapture that number as support. Is what we're seeing right now a bull flag formation, which will produce the pop higher needed to recapture 20 as support? That remains to be seen, but once again, the jobs number will impact whether this bull flag will manifest or not. And here's a 4-hour chart for the VXN. This is the VIX for the NASDAQ. What's going on here? So far, we get about 34% pop in the VXN, yet the MACD indicator indicates that we have more gains to come. It appears that the VXN hit some resistance today and pulled back, but again, the confirmation will not happen until we see red impressions on the histogram of the MACD from a 4-hour perspective. Then you know that the pop is over and the NASDAQ has bottomed, so trade accordingly. And here's a daily chart for Apple. What's going on here? Back at the support of 172.4, Matter of fact, closed below that number precisely at 172. So if the negativity continues, and this is a bearish candle by the way, we will go down to close the gap at 165.32. We have negative divergence on the hour side, the MACD. The selling is happening on higher than average volume. And once again, as Apple goes, so will the market. And here it is, a 30 minutes chart for Tesla, the souffle. What's going on here? It gapped down and it closed pretty much closer to the highs of the day, by the way, which is not negative all in all, but the formation remains a bear flag formation, indicating that we have more pain to come here. The gap is closed, but if we have more downside, then we're looking down at 995 as the first support. Moving on to tulips. What's going on here in BTC land? We're getting closer to 42,000. The selling is happening on higher than average volume. We have negative divergences on both momentum indicators, although we're getting closer to oversold territory. My number is 42,000. We'll take it from there, but you also have Tulip Bull Novogratz. His number is around 38 to 40,000. So Novogratz is even more conservative than me. We'll see which number is going to provide support, but I am not comfortable to buy here until I see support and confirmation of a bottom. On top of that, I got to see some risk on move in the market, meaning the 10-year yield tops and starts to cool down. Absent of that, buying the dip in BTC right now is the equivalent of catching a falling knife. And lastly, what about AMC? What's going on here? We have a downward sloping trend of resistance. Today, the chart went down, but it rebounded higher, closing pretty much at the highs of the day, forming what it appears to be a bull flag. You know what happened after hours with GameStop. This will impact AMC positively. And the writing was on the wall, by the way, from the performance of Bed Bath & Beyond in the morning. The name was down by over 8% in the pre-market, but it managed to rebound higher and closed the day with gains of almost 8%. And all of this is exciting the meme stock world. We're talking about AMC, GameStop, Bed Bath & Beyond, COS, Express, BlackBerry, all of these names that traded together before. They also trade together when we have pops in meme stocks. We will see if the pop is a trap or not, meaning sell the rip or buy the rip. It will all depend on the 10-year yield, in my opinion. If the 10-year yield pops higher in the morning, understand that the pop in GameStop might not hold. We might see sell the rep here. But if the 10-year yield cools down, depending on the jobs number, then you'll know that the pop in GME and perhaps AMC will continue to build on. It has more juice here than a mere one-day pop. And the important number for AMC is 26. Perhaps it is a gift from the sky that AMC will be able to close the week above 26 with the pump from GameStop, because it looked, at least earlier this week, that it could be an impossible endeavor for AMC to recover 26 as support. But now we have a glimpse of hope that this could happen. So we will see how AMC closes the week. We'll take it from there. But for now, moving on to the conclusion of this video. What do we have on the economic calendar tomorrow? In case you were asleep throughout the video, we have the important number, the non-farm payrolls. This will impact the 10-year yield. By impacting the 10-year yield, it will impact the stock market, specifically the high multiple stocks, one way or the other. And as a trader, you got to be prepared for both scenarios. Whatever happens, you already got a plan. You know exactly what you're going to do by looking at the chart of the 10-year yield. You combine that with the VIX or the VXN, and now you have a solid guideline on how to trade the market. Besides the non-farm payrolls, we also have consumer credit, the unemployment rate, average hourly earnings. The wage inflation will be important in this report. And on top of that, we have other Fed zombies. Today we got Bullard and Daly. We have more Daly tomorrow. But the bottom line is we got what she's thinking. She's in the camp of the Hawks now. The other one we haven't heard from yet is Atlanta Fed President Boystick. We know that he already tilts a little conservative here. He's been calling for tapering earlier than his counterparts Daly, Williams, and the rest of the doves. I wouldn't say that Boystick is a hawk yet. He was pretty much a dove light, shall we say. Not fully dove, but a dove light. The assumption is he's going to join the Hawks too, absent of a surprise from the cooks at the Bureau of Labor Statistics. And with that, ladies and gentlemen, I'm done here. Thank you for listening. Thank you for watching. This is all I got for you for tonight. And I will talk to you again over the weekend.